Welcome to Fort Washington Insights Podcast. I'm Dan Carter, Senior Fixed Income Portfolio Manager. Today we're going to talk about inflation, the topic that seems to be top of mind for consumers, businesses, and investors. For most of the past year, higher inflation has largely been dismissed as transitory, with the upward price pressures from the pandemic expected to fade. Instead, it's remained stubbornly high, and we're seeing price pressures broaden across a wide variety of categories. The market impacts are potentially significant, with Fed policy playing an important role. To discuss these factors and how investors should be positioning portfolios in light of these risks, I'm joined by two guests, Austin Coomer and Nick Sargent. Austin is a portfolio manager for Fort Washington, and Nick is a regular contributor to Fort Washington Insights and is a prior chief investment officer for the firm. Welcome, and Nick, I'll start with you. So the big question on everybody's mind is, are these inflation pressures likely to moderate, as was the thought last year, or should we be concerned that this higher inflation is going to stick around?
Okay, thanks, Dan. My view, first of all, is if this is the most important issues for investors to get right in the coming year. In other words, it will have the greatest impact of financial market returns, both fixed income and equities. So my own view is that I don't expect inflation to stay at the very high readings we've had recently, say in the vicinity of 4 or even 5% in some measures. But I do expect that inflation is going to stay well above the Fed's average annual target of 2%. So my view, the most likely outcome for the coming year would be, say, an inflation reading ballpark of 3.5% to 4%. Okay. The difference in the views is that the Federal Reserve attributes most of the run-up of inflation to the supply shortages associated with the coronavirus pandemic. And I certainly agree that that has been a factor exacerbating the problem. But what I see as the shortcoming of the Fed's view is it ignores the fact that policies, both its own monetary policies as well as fiscal policies, have been very, very accommodative. And what the result has been is that these policies have caused aggregate demand for the economy to expand faster than its productive potential, which is believed to be about 2%. And that is the ongoing source of inflation pressures.
It's a big question, and it's hard to decipher a lot of the data that is incoming. I'm curious, what are you watching as we go forward from here to help you along the way?
Clearly, I look at all the inflation reports that are coming out. You have to discern the headline numbers from the core numbers, the so-called readings excluding volatile components such as food and energy. And inside of that, though, what I'm really looking at is how broadly based are the price increases. The Fed's view had been that they were focused on a narrow range of products, initially lumber or used cars, etc. But I think what the recent inflation readings show is those components have become much more widespread. It's been broader based. Okay. In addition, what I'm looking at is measures of inflation expectations. And here, there's no doubt that if you look at what bond investors are expecting, for the most part, the bond investors are concurring with the Fed's view that inflation is going to come back towards its target next year. And we see this in the measure of, if we look at nominal treasury yields, what's the difference with real yields as implied by the TIPS yields. That shows us we haven't seen a big rise in inflation expectations by investors. But when I look at surveys of households and consumers, that's where we're seeing people who are every day going out and buying goods and services saying inflation's picked up and we think it's going to stay higher. The other thing I'm looking at is the labor market. And here what we are definitely seeing is rising wage pressures And it's showing up most visibly in rising unit labor costs. So I'm taking into account improvements in productivity. And what I believe is that we're in a situation where we actually have a very tight labor market now. The unemployment rate has fallen down to 4.2%, only slightly above when it was when the pandemic hit at 3.5. And what we're also seeing is when we look at surveys again of what are the job openings, record job openings, and when we're looking at jobs filled, there's an unusually large gap. And this indicates that workers believe that there are more opportunities out there. And I would say then that even though the Fed has argued that most of the pressures are temporary, they've started to change their tune. In fact, recently the Fed has said maybe we shouldn't use the term temporary because we recognize some of the pressures will continue into next year.
So you mentioned the labor market. I want to follow up a little bit on that. So part of the Fed's argument that inflation is transitory is that there remains slack in the labor market. You mentioned unemployment is down to 4.2%. But if you look at the number of people employed relative to where we were pre-pandemic, we're still about 4 million jobs shy of that. In light of the Fed's other mandate of maximum employment, how do you view the labor market in this context of trying to achieve maximum employment?
That's a good question. Basically what the Fed used to be focused on primarily was the unemployment rate, and there were other measures that considered part-time workers, and that metric would be called the underemployment rate. But what really the Fed did a year ago in August was to say, now we're going to go look at a broader array of measures of the job market. And so they did develop this concept of the maximum unemployment rate, employment rate. And by that, what they meant was what you're alluding to, Dan, that there's still about 4 million workers or people who had been employed who are no longer in the labor force. So the key question that this poses to me is that the Fed is saying we want to raise the labor force participation rate. And the question I have, though, I think it may be misguided, is what happens when a lot of people saw what went on during COVID and said, you know what, I'm going to take early retirement. Or that you have workers that feel that they don't want to face the exposure of COVID, or that they want to stay home with their children, etc. So I think it's an understandable approach, but I question really that when the number of people out of work has fallen so rapidly, and the latest readings are showing that in both the household survey as well as the establishment survey, I just worry that the Fed is trying to deal with a problem that it really can't influence.
So a key question for markets is how the Fed is going to respond to the dynamics you just described. As we speak, they are tapering their asset purchases, and they seem to be guiding markets to a mid-2022 interest rate increase. Do you think that's appropriate, Nick? Should they be doing more? Should they be doing less? Where do you come down on this?
Oh, I come down decisively on the Fed needs to do more. And the basis for this is that the Fed and investors should ask themselves the following question. Does it make sense to have short-term interest rates at zero, at emergency levels, when number one, the economy has fully recovered all the lost output since the pandemic and most of the lost jobs since the pandemic, when inflation has increased at a much more rapid rate and over a longer period than anybody had envisioned? So, from my perspective, the Fed needs to realize that this is the first real threat of inflation in probably 2 decades. Okay. So what's my concern? My concern is that if the Fed tiptoes into raising rates, number one, it talks about maybe, or the expectation, maybe they'll begin around mid-year next year. But hey, then you've got congressional elections coming up. And usually the Fed wants to be missing in action during an election period. So, if we really followed that path, are we really saying that 2 rate hikes of 25 basis points is going to be sufficient to bring the economy and inflation under control? I'm very, very skeptical. My own view is the current period, there's no exact parallel, but closest would be the late 1960s, when basically inflation had been 1.5% for a long period. And then all of a sudden, fiscal policy turned expansionary, the Fed kept rates too low, and inflation ended the decade closer to 5%. So it didn't go spiraling out of control immediately. But I think the risk is that if the Fed doesn't catch up soon, the longer it waits, the greater the risk that at some point it has to play catch up. And that's when you could see more market volatility.
Inflation's become quite the political hot button here. Anything the Biden administration can do to help this issue?
Well, I would say honestly, right now it's kind of late. But if we go back, and because I've talked about monetary policy, what role did fiscal policy play? And I agree with people like Larry Summers and Justin Furman, who were in the Carter administration, in the Obama administration. And what they're basically saying is when we came to the end of last year and the early part of this year, both the Trump administration and the Biden administration decided to cut more checks for individuals and families as relief payments. And the truth of the matter was, by then, most of the people that received it probably didn't need it. So you're putting more money into the system than it is needed. I'm not talking about extending unemployment benefits, which was necessary. So then on top of that, what I see is now the Biden administration's program of first, we have the $1 trillion infrastructure bill, and that's over 10 years. And now they're debating another bill for climate change and social programs to expand the safety network, ballpark, another $2 trillion over 10 years. What happens is this is going to be an additional source of demand for the economy that already, as I say, even the Fed's forecast is the long-term potential growth rate for the economy is 2%. Well, this past year, we're growing at 5.5%. And my guess would be next year, in real terms, closer to 4%. And so the bottom line is fiscal policy has been too expansionary. So what I believe is it's in the Biden administration's own interest to recognize that the main threat to its reelection or to the midterm elections is that more people are worried about inflation than unemployment now.
Thanks, Nick. Now we'll turn to Austin. Austin, we've talked a lot about the economy and Fed policy. Now let's talk about markets. What are valuations telling us about the issues we've just discussed?
We've seen some volatility here lately, but valuations still broadly reflect a positive economic outlook. If you look at different sectors of financial markets, starting with equities, we think they're actually fairly valued here. Especially when viewed relative to treasury yields, the risk premiums within public equity markets are actually around historical averages of about 5%. So again, relative to treasuries, we think equities have some compelling value here. As you look back to this year, equity earnings are up about 40%, which have really supported valuations and returns, as valuations have actually gotten a little bit cheaper as earnings have outpaced equity returns. Next year, earnings are expected to grow another 8%, which should continue to support equity returns. Switching to fixed income, we actually think credit's on the more expensive level compared to history. Spreads have widened out here recently, but are largely still in their tightest quartile. So what that means is, on average, historically, credit spreads have only been more expensive about 25% of the time. So based on these levels, the market actually expects default risk to remain relatively low for the foreseeable future. And within credit, returns are likely going to be driven by excess carry and yields instead of price appreciation. Where we see the biggest valuation disconnect is probably in interest rates. We've experienced highest inflation and economic growth in 30 years amid a strong year for risk assets, yet the 30-year Treasury is only 12 basis points higher year to date. And as Nick mentioned, after adjusting for inflation, real rates are deeply negative and at historical lows across the curve, and that just doesn't make too much sense to us. So while we're not calling for interest rates to rise to, say, 5-6%, but directionally, it seems reasonable to believe that interest rates should move higher over the next 12 months or so by maybe about a percentage point.
So considering all that, how about positioning? For an investor that has a broad portfolio that includes both stocks and bonds, how should we be thinking about asset allocation?
Balanced portfolios that have a mix of stocks and bonds, we continue to favor an overweight to risk assets based on our economic outlook and current valuations. We believe the economic recovery will continue throughout 2022, and that should bode well for risk assets. As I just mentioned, equity earnings are expected to rise another 8% next year, which seems like a good proxy for returns as valuations are fair in that sector of the market. Relating this back to inflation and how investors can protect their capital in a rising interest rate and inflation environment, we think that overweight to risk assets, particularly equities, is the right mix. Equity earnings are nominal, so they should rise with inflation. So you take inflation and productivity to get your equity earnings, add on some dividend yield, and then potential change in valuations, and we're still looking at average to above average equity earnings for next year. Contrary to that, fixed income are nominal yields. So as interest rates move higher, prices should move lower within fixed income. So overall returns, especially with yields at historical lows within fixed income, seem to be on the lower end compared to history going forward. Within equities, we like maintaining a modest overweight exposure to domestic small caps. Looking just at 2021, small caps have actually underperformed U.S. large caps by about 11%. And that's despite record economic growth following the deep recession of 2020. If you look at valuations of small caps relative to large caps, they're actually trading at a discount of about 25% to large caps. That compares to a historical average of about a 2% premium to large caps. So valuations right there screen favorably for small caps. And again, as we think about 2022, maybe 3 to 4% inflation, 4% real GDP growth, and a continued reopening of the economy, that should bode well for small caps as they're much more levered to economic growth and have a more cyclical tilt to them. Within small caps, we do think it's prudent, though, to focus on the more profitable segment of the market, where companies are well established with more predictable earnings. Switching to fixed income, we're actually seeing value within emerging markets debt. EM debt has underperformed domestic markets this year and screens favorably compared to domestic high yield and investment grade. In fact, emerging markets debt is the cheapest we've seen compared to domestic markets in almost 2 decades. And you got to ask yourself, is that warranted? Well, we think some of it is. You've seen emerging market central banks preemptively tightening financial conditions in advance of the Fed, but we think the broad underperformance of emerging markets is overdone. We're actually finding pockets of value within the high yield market within emerging markets debt in certain Latin America countries.
So I think we'll wrap it up there. I'd like to thank Nick and Austin for their thoughts. And just a reminder to visit the Insights section of our website, fortwashington.com, for additional content related to important issues facing investors.